An easing of trimmed mean inflation figures in the latest monthly CPI data drop has raised hopes of the RBA beginning its rate cutting cycle from February. But with inflation still above the RBA's target band, is it enough? And is it falling fast enough for the RBA to be satisfied that now is the time? Joining me live is Moomoo Chief Commercial Officer Michael McCarthy. Michael, it's good to see you. So we had that mean trimmed inflation figure. It looked like the RBA, looked at more by the RBA, that figure. It did ease slightly. Treasurer Jim Chalmers claimed it's another win in the fight against inflation. Was it, in your opinion?
Well, we can't dispute that core inflation measure, the key measure, fell from 3.5 to 3.2% and is heading into the band, it seems, of 2 to 3% that the RBA prefers. It's good news in that respect, but we're nowhere near where we need to be, and we really need to see much more action on fighting inflation and getting it sustainably down into that band. There seems to be a lot of thought around the idea that 2.9% would equal an RBA rate cut, particularly if we saw that figure in the quarterly data due at the end of this month. But the reality is there's no pressure on the RBA economically to cut rates. Their mandate revolves around prices and unemployment remains nearer historic lows and what economists might call full employment than anywhere near an area of concern. And with unemployment in such a benign situation, there's no economic pressure on the RBA. Having said that, there are a lot of beneficiaries from a rate cut, whether you're a mortgage holder or a leveraged corporate or a government seeking re-election. So there's a lot of social and political pressure, but I think the RBA board and the governor have been signalling very clearly with their use of that word sustainably below the target rate that they're not in a hurry to cut. And I don't think we'll see an interest rate cut in Australia before the second half of this year.